Hey, what's up everyone? It's Rupesh. In the world of investing there are tons of strategies out there, but today we're diving deep into two of the most popular value investing and growth investing. These approaches are like night and day, appealing to totally different investor personalities and goals. Value investing is all about finding those hidden gems companies that the market might be undervaluing. Think of it like finding a steal at a discount store. You're getting more than what you paid for. On the flip side, growth investing is like hopping on a rocket ship headed for the moon. You're looking for companies with massive potential, even if their current value seems sky high. In this video, we're breaking down the ins and outs of each strategy, comparing their pros and cons, and helping you figure out which one aligns best with your financial goals and risk tolerance. So whether you're a seasoned investor or just starting, stick around, hit that subscribe button, and let's get you making those smart money moves. Them for the long haul and watching the profits roll in. Now let's switch gears and talk about growth investing. If value investing is about finding hidden gems, growth investing is like strapping yourself to a rocket ship and blasting off to the moon. We're talking about investing in companies with massive growth potential even if their current valuations seem high. Think of companies like Tesla or Amazon in their early days. Their stock prices were through the roof, but investors were willing to pay a premium because they believed in the company's potential to disrupt entire industries. Growth investors are all about finding the next big thing, the companies that are going to revolutionize the way we live, work, and play. They're less concerned with traditional valuation metrics like PE ratios, and more focused on revenue growth, market share expansion, and the company's ability to innovate and stay ahead of the curve. They're willing to stomach more risk and volatility in exchange for the potential for those massive returns. One of the biggest names in growth investing is Peter Lynch, the legendary fund manager who crushed the market with his picks. He was all about finding those fast-growing companies with a competitive edge, and his track record speaks for itself. Risk tolerance. Now that we've gone over the key differences between value and growth investing, let's dive into the advantages and disadvantages of each strategy. Starting with value investing, one of the biggest advantages is that it tends to be less volatile than growth investing, especially during market downturns. Why? Because value stocks are often those solid, established companies with strong balance sheets and a history of weathering economic storms. Another advantage is that value investing focuses on tangible fundamentals. Value investors are looking for companies with strong earnings, solid assets, and a proven track record of success. This makes it easier to assess a company's true worth and reduces the risk of investing in companies that are overhyped or based on speculation. However, value investing does have its drawbacks. One of the biggest is that it can be slow and require a lot of patience. Undervalued companies can take years to reach their full potential, and in the meantime, your returns might lag behind those of growth investors. On the other hand, growth investing offers the potential for substantial gains in a shorter period. Growth stocks can skyrocket in value, especially if they're operating in hot sectors like technology, renewable energy, or biotechnology. This potential for high returns makes growth investing very appealing to investors who are willing to take on more risk. But, and this is a big but, growth investing is not without its risks. Growth stocks tend to be more volatile than value stocks, meaning their prices can fluctuate wildly, especially in the short term. This volatility can be nerve-wracking for investors and can lead to significant losses if you're not careful. So, we've covered a lot of ground, but here's the million-dollar question. Which strategy is better, value or growth? The truth is, there's no one-size-fits-all answer. The best approach depends on your individual financial goals, risk tolerance, and investment timeline. If you're someone who values stability, has a long-term investment horizon, and prefers to sleep well at night, knowing your investments are in solid, undervalued companies, then value investing might be the way to go. You're playing the long game, focusing on those steady, consistent returns over time. But if you're someone who thrives on excitement, is comfortable with higher risk, and is looking for the potential for those explosive returns, then growth investing might be more your style. You're betting on the future, investing in companies that you believe will revolutionize their industries and generate massive returns. Now here's the thing, you don't have to choose just one. You can create a diversified portfolio that includes both value and growth stocks. This blended approach can help you manage risk while still participating in the potential upside of growth companies. It's all about finding the right balance for your unique financial situation. Let's bring this all together with some real-world examples. First up, let's talk about Warren Buffett and his value investing prowess during the 2008 financial crisis. While everyone else was panicking and selling off stocks, Buffett saw an opportunity. He swooped in and bought up shares of undervalued banks and other companies that he believed were fundamentally sound but temporarily beaten down by the market. And guess what? He was right. As the market recovered, those undervalued companies rebounded and Buffett's investments soared in value. That's the power of value investing, finding those hidden gems when everyone else is selling. Now let's look at an example of growth investing in action, Amazon. Imagine if you had invested in Amazon back in the late 1990s when it was just an online bookstore. Back then, Amazon's stock price was a fraction of what it is today. But investors who believed in Jeff Bezos' vision and Amazon's potential to disrupt retail were handsomely rewarded. As Amazon grew from an online bookstore to an e-commerce giant, its stock price skyrocketed, turning early investors into millionaires and billionaires. That's the potential of growth investing, getting in early on companies that are changing the world. So, there you have it, value investing and growth investing, two powerful strategies that can help you build wealth in the stock market. The key takeaway here is that there's no right or wrong answer when it comes to choosing between these two approaches. The best strategy for you depends on your individual financial goals, risk tolerance, and investment timeline. If you're looking for stability, consistent returns, and are willing to be patient, then value investing might be a good fit. But if you're comfortable with more risk and are looking for the potential for those outsized returns, then growth investing might be more your speed. Remember, you can also combine both strategies to create a diversified portfolio that aligns with your unique financial situation. The most important thing is to do your research, understand the risks and rewards of each strategy, and invest in companies that you believe in for the long haul. Alright everyone, that's a wrap on value versus growth investing. I hope this video helped you understand the key differences between these two popular strategies and gave you some insights into which one might be right for you. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions that align with your financial goals and risk tolerance. So, what do you think? Are you team value or team growth? Or maybe you're a little bit of both. Let me know your thoughts in the comments below. And hey, while you're down there, hit that like button and subscribe to the channel for more videos on personal finance, investing, and building wealth. Thanks for watching, and I'll see you in the next one.